A stock that stands at 256 pence with a market capitalization of £1 billion, and analysts see an average of 272 pence here, up to 310 at Canaccord. 6 out of 7 analysts say buy, and the best part, production is expected to more than double to over 65,000 barrels per day by the end of the year. We're talking about Serica Energy, the most aggressive buyer in the British North Sea. And here's the catch, they just reported a loss of 52 million. Production was very poor last year and the British windfall tax is eating up the profits. So is it an opportunity or a trap here? And that's what we're looking at today, as always, of course, without the marketing spin. Serica Energy is an independent oil and gas producer focused on the British North Sea. Listed on the AIM in London under the ticker SQZ. The core assets, the Bruce Keith Rhum cluster in the northern North Sea basin. That's the cash cow here. In addition, through the Tailwind acquisition in 2023, there's Triton FPSO, Columbus and Mansell. And brand new, the Greater Lagan area, a 40% stake purchased from Total Energies. And that brings in more than 5,000 barrels per day net. This is a strategic position in west of Shetland. Important to know, Serica has the Rhum field, which is operated in partnership with the Iranian NIOC. There's always a sanctions risk here, but operationally, the field is currently running stably. Let's take a look at my entry point here. I opened a small position back then because it was just a speculation for me. That's why I hold a total of 50 shares. My entry point was at €1.72. Currently, we are trading at a price of €3.07. That corresponds to a plus of 78%, and I have already received a net dividend of €6.60. The 52-week high and low is between €2 and €3, currently at €3.08. Investing sees a fair target of €3.68 here. If you also want to use Investing Pro for your fundamental analysis, you can get a 15% discount through my link. You can find the link in the pinned comment or in the video description. I'd say let's jump right in, starting with the full annual figures for 2025. The fiscal year for 2025 published on March 26th, so it's fresh right now. Revenue $601 million, down from $727 million the previous year. Reason, lower production due to unplanned outages of the Triton FPSO. Production for 2025 was only 27,600 barrels per day. That's down from 34,600 in 2024, and that was just very disappointing. Operating cash flow was $180 million, down massively from $452 million. The capital expenditure was at $250 million here. And now the elephant in the room, a loss after tax of $52 million, even though there was an $80 million operating profit before tax. And what happened here? A $130 million deferred tax, the effective tax rate is at 165%. Yes, you heard that right. 165%, that's the windfall tax that's eating everything up here. Net debt is $200 million. Cash is down to 100, cash is down to 31 million, but total liquidity is at 290 million, including credit lines. And very importantly, tax loss carryforwards worth over 1 billion, and that's just a hidden treasure. Now let's move on to the growth story, and this is where it gets exciting. Serica completed 4 acquisitions in 2025 at a combined price of only $3.30 per barrel of 2P reserves, and that's extremely cheap here. As a result, reserves have increased by 19% to 138.5 million barrels. Pro forma resources are at 112.6 million barrels. And now, for the headline, production is expected to rise to over 65,000 barrels per day by the end of 2026. And that's more than a doubling compared to the 27,600 from 2025. Currently, and this is proof that it works, production has already been over 50,000 barrels per day since March, now that the Triton FPSO is running again. Year to date, the average is 38,600 barrels. The guidance for 2026 is well over 40,000 as an annual average. And what do the analysts say here? Revenue for 2026 of 1.2 billion. That would be a pure doubling compared to 2025. With oil prices over $100, unfortunately currently due to the Hormuz crisis, that's even a conservative calculation right now. Let's move directly to the dividend and the valuation, which is what ultimately interests us the most, so to speak. Serica maintained the final dividend at 10 cents at 10 pence per share despite the loss. Ex-dividend on June 25th. Payment on July 24th. At a current price of 256 pence, that's around a 5% yield, just on the final dividend alone. With an interim dividend, historically it's more like 5 to 6. Valuation, market capitalization at around 1.7 billion pounds. With 391 million shares, if analysts are right, with 1.2 billion in revenue in 2026. We're talking about a price to sales ratio of under 1. EV to EBITDA historically under 2, and the PE ratio is distorted due to the EPL burden, but on an adjusted basis it's still in the single digits. The analyst targets here average 272 pence, high at 317 pence, from Stifel at 281, Canaccord at 310. Berenberg just initiated with a buy and 300 pence. 6 out of 7 analysts here say buy. Now let's move on to the risks and what speaks against it. No investment is without risk, of course, and with Serica there are unfortunately several. First, the Energy Profits Levy. The British government confirmed in November 2025 the windfall tax will remain until March 2030. Effective tax rate on UK Upstream at 75%. Serica management calls this a missed opportunity and is pushing for abolition, but currently it's reality. The $1 billion in tax loss carry forwards cushion this, but only over time. Second, an operational risk. The Triton FPSO caused massive outages in 2025. North Sea infrastructure is old, weather brutal, unplanned shutdowns are not uncommon. Production has to deliver. 65,000 barrels by year-end is also an ambitious goal here. Third, Rhum sanction risk. The Rhum field is partially owned by the Iranian NIOC. If Iran's sanctions tighten, this could become a problem, especially now with Hormuz in the headlines. Fourth, AIM listing. No FTSE index, low liquidity, little institutional coverage. That can swing both ways, but it also means if the story delivers, there's still a lot of repricing potential in the end. Let's also come to my conclusion and my thesis. Bull case, production delivers 65,000 barrels of oil equivalent per day. Oil stays above $100 because of Hormuz. Revenue doubles to $1.2 billion. Dividend is increased, tax loss carry forwards take effect. Repricing towards 310 to 400 pence. Bear case, EPL remains crushing, Triton fails again. Hormuz situation pushes oil below $70. Iran sanctions hit the Rhum field. Price falls to 180 to 200 pence. My thesis, Serica is a deep value play with a clear catalyst. Doubling production at current oil prices with the Hormuz crisis at its back, the stock currently has a tailwind. The EPL is the elephant in the room here. But the $1 billion in tax assets and extremely low valuation also provide a buffer here. For me, it's a classic contrarian buy. High risk, but with an asymmetrical risk-reward ratio, which is why my position was so small when I entered. As always, this is not investment advice, but just my personal strategy. What do you think of Serica? Do you hold the stock? Did you know the stock? Let me know in the comments. Otherwise, I'd appreciate it if you gave the video a like. If you're not a subscriber yet and don't want to miss any more Upstream episodes, portfolio updates, or weekly reviews, I'd love for you to subscribe. Otherwise, I wish everyone successful investing. See you in the next video. Until